Should you join the manufacturing rush? Is it a golden opportunity or just another hype? Let's start by looking back at history. Remember the infrastructure boom of 2006, 2007? The buzz has shifted to manufacturing, with initiatives like Make in India and Aatmanirbhar Bharat. The government is pushing hard to revitalize the sector. Companies like Apple and Google are setting up manufacturing plants in India. Foxconn announced a $1.5 billion investment, and Micron has established a semiconductor base in India. Welcome back, friends. Today we're diving into a topic that has been generating a lot of buzz: the manufacturing sector in India. Should you join the manufacturing rush? Is it a golden opportunity or just another hype? Manufacturing in India is gaining momentum like never before. With government initiatives and private investments pouring in, it seems like the perfect time to jump on the bandwagon. But is it really? Let's find out. Let's start by looking back at history. Remember the infrastructure boom of 2006, 2007? It promised massive returns, with everyone betting on India's infrastructure growth. Mutual fund companies launched numerous funds focusing on infrastructure, and investors were ecstatic. But then, the excitement fizzled out spectacularly. By March 2013, nearly all infra funds were bleeding. From May 2007 to May 2022, infra funds delivered an annualized return of just 8.3%, barely matching the public provident fund returns. In contrast, flexi-cap funds returned 11.7%. The infrastructure hype didn't deliver as expected. Now, fast forward to today. The buzz has shifted to manufacturing, with initiatives like Make in India and Aatmanirbhar Bharat. The government is pushing hard to revitalize the sector. But the question remains: will manufacturing go the way of infrastructure, or is it genuinely poised for long-term growth? Let's explore this in detail, thanks to the insightful coverage by Sanket Dhanorkar in the Economic Times Wealth. The narrative sounds promising. The government is offering incentives through the production-linked incentive schemes, aiming to boost manufacturing in electronics, pharmaceuticals, telecom hardware, and more. Companies like Apple and Google are setting up manufacturing plants in India. Foxconn announced a $1.5 billion investment, and Micron has established a semiconductor base in India. These are positive signs, right? But let's not get ahead of ourselves. Analysts warn us to be cautious. While the manufacturing sector shows potential, it's essential to remember that similar promises were made during the infrastructure boom. The initial excitement led to poor returns for many investors. So, what makes manufacturing different this time? For one, manufacturing is more diversified. The nifty India Manufacturing Total Return Index includes sectors like auto and auto components at 31%, capital goods at 21%, and healthcare at 14%. Unlike infrastructure, which was heavily reliant on a few sectors, manufacturing covers a broader range, reducing the overall risk. And there's more. The economic activity reflects strong manufacturing growth. In March, the HSBC India Manufacturing PMI Index reached a 16-year high of 59.1, indicating robust expansion. India also achieved record merchandise exports of $778 billion in 2023-24. These figures are encouraging. However, there are still concerns. Despite the initiatives, manufacturing contributes only 15% to India's GDP, far from the targeted 25% by 2022. Other countries like Vietnam and Mexico are attracting significant FDI, while India's share hasn't increased proportionally. Net FDI in India fell by 62% to $10.6 billion in 2023-24. This raises questions about the sustainability of the manufacturing boom. Let's talk about the mutual funds focusing on manufacturing. Recently launched manufacturing funds from HDFC and Baroda BNP Paribas are creating excitement. The last time there was such excitement around a theme, it ended up disappointing many investors. The initial returns might look good, but sustaining them over the long term is the real challenge. For instance, the average returns of flexi-cap funds have been higher than those of infrastructure funds over the years. Will manufacturing funds face a similar fate? Analysts are divided. Some believe that with clear government intent and a supportive macro environment, manufacturing presents a multi-decade investment opportunity. Others caution that the current valuations might not justify the hype. Stocks are trading at a significant premium, and the true potential might be already priced in. There's also the issue of progress across sectors. While sectors like electronics and pharmaceuticals show promise, others like textiles, IT hardware, and specialty steel lag behind. This uneven progress could impact overall returns. So, should you join the manufacturing rush? It's a complex decision. On one hand, there are promising signs with government support, significant investments, and strong economic activity. On the other hand, there are risks of overvaluation, uneven sectoral progress, and potential disappointments like the infrastructure boom. If you're considering investing in manufacturing-focused funds, it's essential to do your homework. Diversify your investments, keep a close watch on sectoral progress, and be prepared for a long-term commitment. Manufacturing could indeed be a lucrative opportunity, but it requires careful consideration and a balanced approach. A big shout-out to Sanket Dhanorkar and the Economic Times Wealth for their comprehensive coverage on this topic. Thank you for joining us today. Stay tuned for more insightful and exciting content. And remember, in the world of investing, caution and thorough research are your best allies. Until next time, stay happy and healthy. Keep learning and happy investing.